Hey everyone, welcome to this explainer. Today we're unraveling a pretty fundamental mystery about how the stock market actually works. Almost everyone who invests lives entirely in just one half of the market and never even notices the other half exists. By the end of our time together today, you're going to understand exactly where your shares come from, where your money actually goes, and why stock prices move the way they do. Let's get right to it. Okay, let's dive into this. I want you to imagine pulling out your phone, opening up your favorite investing app, and buying shares of massive companies like Reliance or TCS. You tap buy, the shares pop into your account, and it all feels, well, perfectly seamless. But when you make that transaction, who is actually on the receiving end of your cash?
Here is the massive aha moment. The company? They don't get a single rupee of your money. Sounds completely backwards, right? But it's true. When you buy shares of Infosys on an ordinary Tuesday, Infosys itself has absolutely nothing to do with the transaction. That one single fact separates the entire stock market into two completely different halves. And honestly, once this concept clicks for you, everything else about investing is going to make a whole lot more sense.
And this brilliantly illustrates the difference. Think of a company's shares exactly like a book. On side A, there's the moment the book is first printed and sold by the publisher. In this scenario, the author gets paid. That's a primary sale. But on side B, think of every used book sale that happens for decades after that initial print run. You buy a copy from a friend or maybe a secondhand bookstore. Both are very real sales for sure, but only the first one actually puts money in the author's pocket. The stock market works exactly the same way.
So, let's kick things off with side A of our market life cycle, where shares are born.
We call this the primary market. Simply put, it's where a company sells brand new, freshly minted shares directly to investors for the very first time. This is the one and only time that the money you pay goes straight into the company's bank account. They issue the shares, you hand over the cash, and the company walks away with that capital to use for its business.
So how does this actually happen in the real world? Well, it happens through a few specific events. The most famous, of course, is an IPO, or initial public offering. This is when a private company decides to sell shares to the public and list on an exchange for the first time. But a company can return to the primary market later on too. They might do a follow-on public offer, an FPO, where an already listed company issues even more new shares. Or they might do a rights issue, giving existing shareholders first dibs on a fresh batch of shares. In all of these cases, the company is using the primary market to create fresh shares so they can pay down debt, build new factories, or fund their next big expansion. Now, because this involves companies taking cash directly from the public, it requires some incredibly strict oversight. SEBI, India's market regulator, polices this stage closely. Before a company can take your money in the primary market, SEBI reviews their prospectus, basically their massive disclosure document. They're checking to ensure that promoters aren't quietly siphoning funds and making absolutely sure that you, the investor, are getting a completely honest and transparent picture of the business before a single rupee changes hands. All right, let's transition over to the environment where almost all everyday retail investors operate, the giant second-hand market. This is the secondary market. And honestly, it's what most people are referring to when they casually say the stock market. In the secondary market, investors are buying and selling shares that already exist. You're buying them from each other. If you buy 10 shares of a stock today, you are buying them from another investor somewhere out there who wants to sell them. You are definitely not buying them from the company itself. Now, what's really interesting about this is where this massive secondhand market actually lives. It lives on the exchanges. In India, that primarily means the NSE, the National Stock Exchange, and the BSE, the Bombay Stock Exchange. And just as a quick historical side note, the BSE was founded way back in 1875, making it Asia's oldest stock exchange. Pretty cool, right? These exchanges are basically giant, highly regulated matching engines that allow investors to trade existing shares with one another.
To really cement how these two markets interact, let's look at a real-world mini-narrative, the Chai Corner story.
Imagine a fictional startup called Chai Corner decides to go public. On IPO day, in the primary market, the company offers 1 crore brand new shares to the public at $100 each. Investors apply, the shares get allocated, and the result is that Chai Corner collects roughly 100 crore rupees in cash. The primary market has done its job perfectly. The company now has vital, real money to go out and open 50 new outlets. That evening, the shares officially list on the NSE, ready to be traded. Let's move to and see how this builds the very next morning. Priya, who was one of those initial investors who bought shares directly from Chai Corner in the IPO, sees that the market buzz is really strong. The price has gone up, so she decides to sell her 100 shares to another investor named Arjun at $130 each. This transaction right here, this is the secondary market in action. Priya is selling to Arjun.
Because Priya bought at 100 rupees and sold at 130 rupees, she pockets a beautiful 30 rupees per share gain. That is pure profit for Priya, made simply by trading with another individual investor.
But what about Chai Corner in all this? Well, here is the stark reality. Chai Corner sees absolutely 0 rupees from Priya's highly profitable trade with Arjun. The company is completely unbothered and uninvolved. They already got their 100 rupees per share back during the IPO. Every single trade after that listing day, whether the stock price runs all the way up to 500 rupees or slumps down to 60 rupees, is just shares moving between investors in the secondary market.
So, we've got the theory down. Let's pivot to the direct, practical applications of this knowledge for you, the everyday retail investor. Why this matters to you. There are 3 core takeaways here that actually shape your investing reality. First, when you apply for an IPO, you are fundamentally funding that company directly based on the terms in their prospectus. Second, daily price fluctuations, even severe stock crashes, don't actually drain a company's bank account. If a stock drops 5% in a day, the company isn't suddenly losing that cash. That money moved between investors a long time ago. The daily price just reflects what people are collectively willing to pay right now. And third, a deep secondary market provides something truly magical: instant liquidity. Because that massive secondary market exists on the exchanges, you are never stuck holding shares forever. You have the total freedom to turn those shares back into cash whenever you like. In fact, in India today, most trades settle on a T+1 standard. That means the cash and the shares swap hands just 1 working day after you trade. And even more impressively, since 2024, SEBI has been rolling out optional T+0 or same-day settlement for the top 500 stocks. That means you can exit trades and have things settled in incredible time. That lightning speed is a pure feature of the secondary market that you use all the time without even thinking about it. So, the crucial point is this. In the primary market, the seller is the company, and the company gets your money during events like IPOs, FPOs, and rights issues. But in the secondary market, the sellers are other investors, and other investors get the money during your daily trades on the NSE or BSE. The primary market raises capital. The secondary market gives you liquidity.
I want to leave you with a final thought. The next time you place a trade on your app, ask yourself, am I buying newly created shares directly from the company, or am I buying used shares from another investor? 9 times out of 10, it's the latter. You are trading in a giant secondhand market, and that's exactly what makes it so wonderfully easy to get in and out of your investments. But wait, if millions of people are trading used shares every single second, how exactly does the stock exchange magically match your specific buy order with someone else's sell order in the literal blink of an eye? Well, sit with today's concepts for a bit, because order matching is exactly what we're going to be diving into in our next explainer. Thanks so much for learning with me today.